It's that time of year, the Q3 wrap up with one of my favorite economists, Dr. Elliott Eisenberg. If you want to stay up to date on both local and national real estate news and the market, don't forget to like and subscribe. I'm 𝐍𝐚𝐭𝐢𝐨, your Santa Cruz real estate expert and your personalized real estate concierge. Let's take a look at the 2023 Q3 National Economic Overview. Somewhat surprisingly, the third quarter of 2023 is likely to be a decent quarter for the U.S. economy. While most market watchers and economists thought that we would have drifted into that long-awaited recession by now, most of the third quarter data is fairly strong. In the most recent jobs numbers, September payrolls rose by a surprisingly strong 336,000, and July and August numbers were revised up 119,000. Moreover, job growth was widespread. The labor force participation rate is rising, and wage growth slowed to 4.2% year over year, and an annualized rate of 3.4% over the last 3 months, a rate nearly commensurate with 2% inflation, largely because of substantial fiscal stimulus, which has yet to fully dissipate. The current expansion has not yet turned recessionary. However, by year end, excess savings will probably have been depleted, and starting in October 1, 2023, student loan repayments will recommence. We are already starting to see the early indicators of slowing consumer spending and falling real income as August auto sales slumped 4.6% month over month, and consumer credit card balances are increasing. In terms of inflation, August CPI rose a sharp 0.6% month over month, largely attributable to more expensive gasoline and diesel. Core inflation rose 0.3% month over month, its highest reading since May, but just 4.3% year over year, its lowest reading since September of 2021, and the 10th decline in 11 months. However, August core services inflation rose 0.6% month over month, unchanged since March. The Fed's favorite measure of inflation, core services minus housing, rose 0.4% month over month, its highest reading since March. Thus, while generally falling, inflation remains uncomfortably high, and therefore the Fed left the Fed funds rate unchanged in late September, but signaled a willingness to possibly raise it 25 BPs in the future, a hawkish pause. However, it really doesn't matter if the Fed raises rates once more or at all, because inflation and the health of the economy do not hinge on 25 BPs. Instead, what matters is how long the Fed keeps rates at the terminal level, and that is still to be determined. According to the latest Fed releases, the plan is to reduce interest rates at the slowest pace ever. However, be assured that if the current hikes are taking longer to slow the economy due to a myriad of factors, when the weak economy arrives, as it almost always does, rates will quickly fall, or as the saying goes, interest rates go up on a staircase and they go down on an elevator. Alternatively, if the economy stays pleasantly strong, the Fed may or may not raise rates more, but will certainly not lower them anytime soon. There are other significant headwinds that still pose a risk to the hoped-for smooth landing. In addition to the resumption of student loan payments in October, the possibility of a U.S. government shutdown remains high, especially with the chaos in Congress. The ongoing Russian attack on Ukraine and now the devastating prospects of an extended conflict in the Middle East will have continuing economic impacts on the world economy and raise the potential of spikes in fuel prices. Ongoing labor strikes offer the real possibility of impacting GDP in the short term and generating additional wage inflation. Still, all things considered, the prospects for the fourth quarter of 2023 are good, with the probability of a recession shifting to the first half of 2024, if at all. 2023 Q3 National Housing Market Overview. The national housing market continues to be dominated by high mortgage interest rates, the highest since 2002, and the impacts to both supply in terms of the iron grip of mortgage rate lock-in, as evidenced by the lack of new listings, and on demand by pushing the monthly home mortgage payment out of the reach of many potential buyers and showing itself in very low closed sales. sales. Existing housing sales slipped to their lowest level since January of 2023 in August, and August pending home sales fell 7.1%. High interest rates have pushed up the average interest and principal payment for new borrowers using a 30-year mortgage to $2,306. 2 years ago, only 5% of new borrowers had a payment over $3,000 per month. Today, it's almost 25%. Moreover, high rates have depressed the dollar volume of cash-out refi activity by about half from 22 Q1, when it was almost 1% of available equity, quarter to 0.4% quarter, a decline of $40 billion this quarter. Still, even with high rates, home prices remain high and stable. On a year-over-year basis, the Freddie Mac Home Price Index, which includes only loans purchased by Freddie and Fannie and includes appraisals, was up actually 4% in August versus 3% in July. Year-over-year appreciation peaked in July 2021 at 19.1%, and annual appreciation bottomed out at 0.9 in May of 2023. Median home prices increased from $406,700 in July to $407,100 in August 2023, and made this the third consecutive month with home prices above $400,000. This is nationwide. It was the highest August price ever and is up from $389,500 in August of 2022. Home prices has stayed at or near record levels in most areas for one key reason: the relative lack of available inventory. Inventory ticked down slightly from 1.11 million units in July to 1.1 million units in August, the lowest August level ever, and well below the 1.28 million units on the market a year earlier after record housing inventory lows during calendar years 2020, 21, and 22. Quarter 2023 started off weakly. In January through April 2023, for sale inventories were slightly above the record lows set in 2022. However, from May through August, inventories set all-time lows, and by wide margins, it's likely that monthly low records will keep being set for the rest of 2023. Home builders recognize the gap and are trying to fill the available inventory void, and because of this increased new home building activity, the percentage of homes for sale that are new is around 30%, double the historic average. While the single-family housing market is enjoying solid price appreciation and strong construction activity due to a severe lack of existing inventory, the multifamily market struggles mightily. Financing is increasingly difficult as vacancy rates and insurance premiums rise, rents decline, and mortgage rates increase. The market also struggles to absorb substantial recent overbuilding, and prices are falling due to the rising capitalization rates. As a result, multifamily starts have declined a sharp 41% year over year. Banks are currently tightening lending standards for commercial real estate loans and commercial and industrial loans, and as a result, office and retail space is somewhat shaky, while other types of non-residential construction like student housing, warehouses, and logistical hubs and manufacturing facilities are doing quite well. While the shake-up in commercial real estate and construction is no surprise given rising rates, what is interesting is that it takes about 63 weeks for the tightening to make its way through to credit growth. This is an excellent example of why the effects of the rate hikes that began in March 2022 are only now having a material impact on areas outside of the housing market. 2023 Q3 Regional Economic Overview. The MLS listings area is one of the areas that has suffered the most from rising interest rates, both in terms of the immediate impacts on the housing market and also from interest rate related impacts on capital markets. The tech sector is powering through by leading the way with the innovation of artificial intelligence. ChatGPT and other AI platforms are increasingly being integrated into the product lines of Amazon, Microsoft, Apple, Google, and the rest of the Magnificent Seven, along with thousands of lesser-known offerings as they actively work to make AI a part of the daily life. Business and entertainment presenting an enormous growth opportunity for the region. This is likely to offset some of the post-pandemic tech job losses, and the AI opportunities may even serve as an enticement for some employers in the return to office sweepstakes. Still, there is no understating the significant and multiple impacts of high interest rates on the tech sector. The steady rise in interest rates has clipped the wings of equities, and tech stocks have been especially hard hit as their PE ratios are future focused. IPOs are still a hard sell, and banks have tightened lending standards in the wake of the Silicon Valley Bank failure. Banks are also pulling back as their balance sheets have taken a hit on their bond holdings and other long-lived assets, and their depositories are demanding higher rates of return. Additionally, as rates on treasuries and corporate bonds rise, investors can hold highly stable fixed income securities and still earn excellent rates of return. These factors make it more difficult for startups that have been the heart of the MLS listings area to raise necessary capital. There are also the compounding effects of higher interest rates and low office occupancy rates on the commercial real estate market. San Francisco is considered by some to be the epicenter of the problem, and while the MLS listings area may benefit somewhat from San Francisco's misfortunes, it is not altogether immune. Many employers are still in the wait-and-see mode regarding office space as they explore ways to entice, encourage, and even extort employees to return to the office. And it will take some time to see how the excess office space will be absorbed in the market. Recent data from Kastle Systems shows that office attendance plateaued months ago and has not risen above 50% nationally and is much lower in the MLS listings area that we study. Importantly, please remember that all of the aforementioned showing is a feature, not a bug, of Fed policy and is part of a very intentional plan to cool the economy and avoid runaway inflation. Importantly, it is not a permanent state of affairs, and the tech sector will power through this just as they did with the dot-com bust of 2000. Remember that? That was fun. 2023 Q3 housing market overview and highlights. After a tough first half year, the third quarter of 2023 was a bit of a bright spot for the MLS listings area, especially in terms of prices. Both median and average prices were generally up across the region, and homes sold at or above listing price. Sales remained slow, constrained by both high rates and low inventories, and days on market has remained relatively stable. Still, a recent study by Bank of America shows that San Francisco and San Jose saw the largest outflow of people during the pandemic, and they remain the two cities with the highest rates of outward migration even now. Dr. Eisenberg comments, as more employees slowly return to the office, we are probably witnessing the beginning of the tail end of this painful part of the migratory process. Year over year, single-family median home prices across the region generally rose during 2023 Q3. Santa Clara County saw the highest percentage of year-over-year growth, with prices rising 9.6% to $1,809,000. Prices in Monterey County rose 5.9% to $900,000, and prices in San Mateo County gained 2.5% to $1,825,000. Single-family home prices in Santa Cruz County stayed flat at $1,250,000, while San Benito County saw the only decline in value, with home prices falling 1.4% to $786,986. In the common interest market, year-over-year median prices were up across the region, with the largest percentage gain in Monterey County, where prices rose 21% to $822,500. Townhome and condo prices in San Benito County rose 13% to $599,000. Prices in San Mateo County rose 5.5% to $949,500, and in Santa Clara County they rose 4.9% to $965,000. The smallest gain in multi-family median home prices was in Santa Cruz County, where prices rose a nominal 0.2% to $803,750. Year over year, closed sales declined again this quarter by about 15%, and overall sales volume was down about 10% from last year. In terms of overall sales dollar volume, Santa Cruz County saw the largest percentage decline of 14.9%, while San Benito County was the only area year over year volume increased by 2.5%. New listings of single-family homes generally declined across the region compared to last year, although they rose by 2.1% in Santa Cruz County. The largest percentage year-over-year decline was in Monterey Monterey County, where they declined by 17.4%, followed closely by Santa Clara County, where they declined by 16.2%. New listings of single-family homes in San Benito County declined by 7.3%, while in San Mateo County, they declined by 6.3%. Active listings declined by about 19% across the region, with available inventories in the Santa Clara County down 28.7%, San Benito County 19.7%, Monterey County down 16.3%, and San Mateo County inventories down 11.8%. In Santa Cruz County, active inventories rose 7.3% in terms of months of available inventory of single-family homes. San Benito County has 3 months of inventory, while Santa Cruz County has 2.5 months. Monterey County has 2.4 months, San Mateo County has 1.8 months, and Santa Clara County has only 1.1 months of available inventory. The percentage of listing price received at sale was at or above 100% across the region, with the largest premium over listing price in Santa Clara County, where properties generally sold for 106% of their original listing price. Average days on market rose in Monterey County to 34 days, up from 27 days last year, and in Santa Cruz County, where they rose from 27 days to 32 days. Days on market declined in Santa Clara County from 24 days last year to 18 days this year. In San Benito County, they stayed steady at 41 days. In San Mateo County, they held at 24 days. To stay up to date on national and local real estate news and the market, hit that like and subscribe button. And now let's take a look at the Santa Cruz numbers as they have come in for November 2023. For single family homes in Santa Cruz County, the sales price to list price ratio increased slightly from 98.3% in October to 99.3% in November, which is down from 100.4% a year ago in November of 2022. The average days on market for single-family homes for the month of November was 28 days, which is down from 30 days on market in October and which is down from 35 days on the market a year ago in November of 2022. The number of active listings for the month of November for single-family homes came in at 259 homes, and the number of single-family homes that sold in Santa Cruz County was 259, with the median sales price increasing from $1,219,000 in October to $1,280,000 in November 2023, which is up from $1,230,000 a year ago in November of 2022. For condos and townhomes in Santa Cruz, we saw the sales price to list price ratio increase from 98.5% in October to 98.8% in November of 2023, which is down slightly from last November 2022 at 99.3%. The average days on market for condos and townhomes for the month of November came in at 30 days on the market, which is up by only 3 days in October 2023, with the average days on market for October 2023 coming in at 27 days on market. The average days on market has increased from 16 days on market in November 2022. The median sales price for condos and townhomes was $712,500 for the month of November, which is down slightly from $725,000 for the month of October 2023. This median sales price is also down from $856,430 a year ago in November of 2022. The number of active listings was 61 in November 2023, and the number of sales for condos and townhomes decreased from 29 closed sales in October to 22 closed homes in November of 2023, which is up from 20 units that closed last year in November of 2022. I'm thrilled to have you here for our November 2023 Santa Cruz real estate market update. The Santa Cruz market is alive and well, and with the right advisor and the right strategy is a great time to take advantage of our real estate market right here in Santa Cruz. So if you are considering selling your home or buying a home, it is a great time to dive in. And the Santa Cruz market opportunities are everywhere, whether you're a buyer looking for your dream home or a seller ready to make a big impact on the market. It's all about understanding the trends and filtering out the noise to make a savvy decision that fits what you are looking for today and what you need for your life and your lifestyle. So to stay on top of the Santa Cruz real estate game, like and subscribe. By doing so, you'll dive into a world of regular updates, expert insights, and exclusive content with the insider knowledge. You'll feel like a real estate pro. I'm Kshamika Fox, your Santa Cruz real estate expert and your personalized real estate concierge. Thanks for tuning in and have a great day.